What does the future hold for Bitcoin and the stock market? Is there an inevitable collision or a harmonious intersection on the horizon? In our rapidly evolving world, these questions have become more relevant than ever. The economic climate is shifting, and with it the dynamics between traditional investment platforms like the stock market and the new kid on the block, Bitcoin. Now, why is this important? Well, simply put, the stock market and Bitcoin are two significant players in our global economy. The stock market, a long-established platform, represents the collective value of some of the most influential companies in the world. On the other hand, Bitcoin, a relative newcomer, has emerged as a potent force in the world of digital currency, challenging traditional notions of value and exchange. But recently, there's been a twist in the tale. Bitcoin prices have experienced a significant downturn, sparking talks of an impending bear market. For the uninitiated, a bear market refers to a condition where prices are falling, encouraging selling. This downturn has been significant enough to make waves in both the crypto and traditional financial worlds. It's led to some industry experts like Huobi co-founder Du Jun predicting that the next major rally for Bitcoin may not occur until late 2024 or early 2025. This prediction is based on the upcoming halving event, a pre-programmed point in Bitcoin's lifecycle where the rewards for mining Bitcoin are halved, effectively reducing the supply of Bitcoin. This reduction in supply, coupled with consistent or increasing demand, could potentially drive prices up. But before we get carried away, it's essential to remember that these are just predictions. The financial world is a dynamic realm where change is the only constant. As we delve deeper into this topic, we'll explore a range of factors that could influence the trajectory of Bitcoin and the stock market, including external factors like geopolitical issues and the aftermath of COVID-19. As we delve deeper into this topic, remember that the financial world is a dynamic realm where change is the only constant. Recent news from the co-founder of Huobi Crypto Exchange suggests that Bitcoin is likely entering a bear market. Now, if you're scratching your head wondering what a bear market is, it's a condition where prices fall and widespread pessimism causes the market's downward spiral to be self-sustaining. Not exactly a party, right? Now let's dive a little deeper. Bitcoin's recent price drop has raised eyebrows and caused some investors to brace for another Bitcoin winter. But it's not all doom and gloom. The co-founder of the Huobi Crypto Exchange predicts that the next major rally isn't expected until late 2024 or early 2025. So what's the holdup? Well, it's all tied to a little something called halving. Halving is a key event in the world of Bitcoin. It's like a surprise guest that arrives every 4 years. During a halving event, the reward for mining new blocks is cut in half, which effectively reduces the supply of new Bitcoin. This scarcity can lead to a surge in Bitcoin's price, as we've seen in the past. Now you might be asking, why should I care about the upcoming halving event? Well, it's simple. It's all about supply and demand. When the supply of something decreases while demand remains the same or increases, the price will generally go up. So, a halving event could potentially trigger the next Bitcoin bull run. But let's not forget that Bitcoin, like any other market, is influenced by a myriad of factors. Geopolitical issues, economic trends, and even global health crises like COVID-19 can all impact the market's performance. The next bull market could be right around the corner or a distant future. Only time will tell. But don't worry, you're not alone in this journey. We'll be right here, navigating the twists and turns of the crypto market together. While internal mechanisms like halving influence Bitcoin prices, external factors like geopolitical issues and the impact of COVID-19 cannot be overlooked. Now let's dive into the realm of these unpredictable catalysts that play a significant role in the crypto market. Geopolitical issues have an uncanny knack for shaking up global markets, and the crypto sphere is no exception. Take, for example, a political upheaval or a sudden change in regulatory policies in a country. These events can sway investor sentiment, either pushing them towards or pulling them away from Bitcoin. In essence, the volatility of Bitcoin prices often mirrors the turbulence of global politics. Then there's the ongoing pandemic. It's no secret that COVID-19 has had a profound impact on economies worldwide. But did you know that it has also left an indelible mark on Bitcoin prices? When the pandemic first hit, we saw a sharp decline in Bitcoin values as investors scampered for the safety of traditional assets. But as central banks started printing money to buoy their economies, many turned to Bitcoin as a hedge against inflation, driving its price to unprecedented heights. Now, as we look ahead, we must acknowledge that these external factors will continue to shape the future of Bitcoin. Will renewed waves of the pandemic push Bitcoin to new highs? Or will a return to normalcy see a shift back to traditional assets? On the geopolitical front, will countries adopt more crypto-friendly policies, or will regulatory crackdowns dampen the Bitcoin rally? These questions underline the fact that the crypto market is far from being a closed system. It's intricately linked to the world at large, reacting to its ebbs and flows. In other words, the future of Bitcoin doesn't solely rest on its internal dynamics like halving. It's also at the mercy of a myriad of external factors, each with its unique set of uncertainties. The external factors, often unpredictable, add an extra layer of complexity to the future of Bitcoin. This complex interplay of variables is what makes predicting Bitcoin's future a challenging yet fascinating endeavor. While the crypto world is bracing for a potential bear market, how is the stock market faring in this economic climate? As we delve into the stock market, we find an intriguing parallel universe, distinct yet surprisingly interconnected with the world of cryptocurrencies. The stock market, the age-old financial arena, is currently experiencing its own set of ups and downs. Just like the crypto market, the stock market is also influenced by a myriad of factors. Economic indicators, corporate earnings, geopolitical events, and investor sentiment. All these elements play a part in shaping the stock market trends. Yet unlike Bitcoin, whose value largely hinges on demand-supply dynamics and halving events, stocks are often grounded in the real-world performance of companies. They are shares of ownership in a company after all. So, while Bitcoin prices have been fluctuating, the stock market has been seeing a different kind of dance. Some sectors have been thriving, others have been enduring the brunt of economic challenges. The tech industry, for instance, has been a roller coaster ride of its own, with tech stocks seeing some significant highs and lows. Now you might wonder, isn't there a correlation between the stock market and Bitcoin? Well, that's where it gets interesting. While both markets may react to some of the same external factors, they don't always move in lockstep. In fact, some investors turn to Bitcoin as a digital gold, a hedge against stock market volatility. But here's the kicker. Despite their differences, the stock market and the crypto market are becoming more intertwined than ever. We're seeing publicly traded companies investing in Bitcoin and crypto-based financial products making their way into the mainstream market. So what does this all mean? Well, it's like two different galaxies gravitating towards each other, each with its own rules, yet influenced by the same cosmic forces. The stock market, with its own set of rules and influencers, moves in tandem yet independently from Bitcoin. As we stand at the cusp of 2025, the future of Bitcoin and the stock market remains intriguing, filled with possibilities. We've delved into the looming bear market that Bitcoin could potentially enter, the unpredictable catalysts that could sway its course, and the parallel universe of the stock market. The halving event in 2024 is expected to be a significant influencer, potentially sparking a bull market. Yet, external factors like geopolitical issues and the ongoing impact of COVID-19 add layers of uncertainty to this prediction. Then, there's the market, a finance that has coexisted with Bitcoin, yet traded on a different wave. But as we move forward, lines may blur. We see a convergence where Bitcoin and the stock market begin to influence each other more significantly, or a collision where the differences in these two sectors become pronounced, leading to distinct investment strategies. Whether it's a convergence or a collision, the future of Bitcoin and the stock market is back to keep us on our toes. Stay tuned, stay informed, and stay prepared for the future. What if I told you that Bitcoin, the digital gold of our era, is on a roller coaster ride, defying the gravity of traditional financial markets? Let's take a step back and examine the thrilling predictions made by Fundstrat and Standard Chartered, two financial giants who foresee a potential surge in Bitcoin prices. Fundstrat, in particular, predicts that the price of Bitcoin could catapult by a whopping 521% to $180,000 before the scheduled halving in April 2024. Now, you might wonder, what's sparking this potential increase? The answer lies in the launch of a Bitcoin ETF, which could potentially add a staggering $100 million in daily demand for Bitcoin. This is no small feat, as the halving event, which essentially reduces daily mining rewards, has historically led to price increases. Sean Farrell, Fundstrat's head of digital asset strategy, is confident that a Bitcoin ETF approval is not just a possibility, but a likelihood. This could be a game changer. attracting new investors and potentially leading to significant financial inflows. Fundstrat even suggests that Bitcoin ETFs could surpass the precious metals ETF market in terms of assets, potentially reaching over $300 billion. That's billion with a B, folks. Other firms like Standard Chartered also have high price targets for Bitcoin, with predictions exceeding $100,000. But it's not just these predictions that are causing a stir. The increased mining profitability allows miners to sell fewer tokens, reducing Bitcoin's supply and potentially pushing prices higher. If Bitcoin's price averages $50,000 by the first quarter of 2024, selling just 27% of mined Bitcoin could generate the same excess cash as selling 100% in the second quarter of 2023. This could impact Bitcoin's inflation rate, lowering it from 1.7% to 0.4% year to year. As Bitcoin continues to challenge the status quo, the world watches with bated breath. As Bitcoin scales new heights, how does it stack up against traditional financial markets? Let's dive into this intriguing comparison. The financial markets are a vast ecosystem, with a multitude of assets jostling for dominance. One such asset that has been making headlines recently is cocoa. Yes, you heard it right, cocoa, the key ingredient in your favorite chocolate bars. In the year 2023, cocoa prices soared by a staggering 47%, reaching an astounding $8,900 a ton. Now, in any normal circumstance, such a surge would be a cause for celebration for cocoa investors. But here's the twist. Despite this significant rise, cocoa prices were left in the dust by the meteoric ascent of Bitcoin. In the same period, Bitcoin's value skyrocketed, leaving traditional assets like cocoa trailing in its wake. It's not just cocoa. Bitcoin and cryptocurrencies have been outpacing other traditional financial markets too. While cocoa prices rose by an impressive 186% over the past 12 months, Bitcoin's gains left even this growth rate far behind. It's a testament to the unique dynamics of the crypto market, where traditional markets are influenced by factors such as weather patterns, political stability, and economic policies. Bitcoin dances to its own beat. Its value is driven by a complex interplay of factors, including technological advancements, regulatory developments, and market sentiment, among others. This comparison, however, is not to undermine the importance of traditional markets. They play a crucial role in the global economy and have their own merits. But it does highlight the extraordinary nature of Bitcoin's rise. In the face of such volatility, Bitcoin and cryptocurrencies continue to hold their own, and as we progress into the era of digital currency, it'll be fascinating how these dynamics evolve. Will Bitcoin continue its ascendancy? Traditional markets regain footing? Only the rise of Bitcoin and cryptocurrencies is not an isolated phenomenon. It ripples through our economy in more ways than one. As more and more people buy into the Bitcoin frenzy, the economic implications are becoming increasingly significant. Take mining profitability as an example. When Bitcoin prices rise, so does the profitability of mining operations. In turn, this allows miners to sell fewer tokens, effectively reducing the supply of Bitcoin in the market. And as we know from Economics 101, when supply falls and demand remains strong, prices can potentially be pushed even higher. This creates a feedback loop that can further fuel Bitcoin's price surge. But the impact doesn't stop there. This reduced supply of Bitcoin can also affect its inflation rate. If we take a look back at 2024, when Bitcoin's price averaged $50,000 in the first quarter, selling just 27% of mined Bitcoin generated the same excess cash as selling 100% in the second quarter of 2023. This effectively reduced the net supply of Bitcoin by around 250,000, impacting Bitcoin's inflation rate and lowering it from 1.7% to 0.4% year to year. This shift in inflation rate might seem insignificant at first glance, but it's an important indicator of the changing dynamics in the Bitcoin market. A lower inflation rate means that the value of Bitcoin is less likely to decrease over time, making it a more attractive store of value for investors. And let's not forget about the potential impact on other sectors of the economy. The rise in Bitcoin prices has led to increased interest in Bitcoin ETFs, which could attract new investors and lead to significant inflows into the crypto market. This could potentially disrupt traditional financial markets and reshape the way we think about investing. In essence, what we're seeing is a fundamental shift in the economic landscape. Bitcoin and other cryptocurrencies are challenging traditional financial systems, and as they continue to rise in value, their impact on the economy is becoming increasingly hard to ignore. With every surge in price, Bitcoin redefines the rules of the game, leaving a lasting impact on our economy. So, where do we go from here? What does the future hold for Bitcoin and cryptocurrencies? The future of these digital assets is a topic of much debate and speculation, but one thing seems clear: they're not going anywhere anytime soon. Forecasts suggest Bitcoin valuations could exceed $100,000 in the future. Some firms, including Fundstrat and Standard Chartered, predict even higher numbers, with prices potentially soaring to around $180,000. These predictions are based on various factors, including reduced Bitcoin supply due to decreased miner selling, and increased demand, particularly with the prospect of a Bitcoin ETF. Speaking of Bitcoin ETFs, they could play a significant role in the future of cryptocurrencies. An ETF, or exchange-traded, is a type of investment fund, exchange-traded product, shares that are tradable on the stock exchange. The launch of a Bitcoin ETF at $100 million demand for Bitcoin attract new investors, leading to significant flows and potentially put prices even higher. Over Bitcoin ETF past the precious ETF market in terms of assets. This would be a special achievement considering the precious metals market is valued at over $100 billion. Such a development would further legitimize other cryptocurrencies in finance, potentially leading to even greater and integration in everyday lives. Important to note, however, these are predictions and possibilities. The future is uncertain, and the world of cryptocurrencies is notoriously volatile. But whether you're a seasoned investor, a curious observer, or a complete novice, the evolution of Bitcoin and other cryptocurrencies is a fascinating journey to follow. As we venture into uncharted territory, one thing is certain: the journey of Bitcoin and cryptocurrencies is one to watch. In recent financial news that could potentially reshape the cryptocurrency landscape, BlackRock, the world's largest asset manager, has made a significant Bitcoin purchase. Now, for those of you who may not know, BlackRock is no small player in the financial world. With trillions of dollars in assets under management, it's safe to say that when BlackRock makes a move, the market pays attention. And boy, did the market pay attention this time. The announcement of BlackRock's intention to dip its toes into the world of Bitcoin sent prices soaring with a staggering 96% price rally in anticipation of the move. It's a testament to the weight that BlackRock carries in the financial sector, and a clear indicator of the potential impact of this purchase on the Bitcoin market. But what does this purchase mean for the world of cryptocurrency? Well, in essence, it's a massive vote of confidence in the future of Bitcoin. BlackRock's decision to invest is a signal to other institutional investors that Bitcoin is not just a fringe asset, but a legitimate part of a diversified investment portfolio. And it's not just about the immediate impact on prices. BlackRock's investment in Bitcoin is likely to have ripple effects throughout the crypto market. The entry of such a major player could spur further institutional adoption, boosting liquidity and potentially leading to greater market stability. This is a significant moment in the evolution of cryptocurrency. It's a sign that Bitcoin is moving from the margins of the financial world into the mainstream. And it's not just about the money. It's about the recognition, the legitimacy that comes with the backing of a financial giant like BlackRock. This unprecedented move by BlackRock certainly sets the stage for an exciting era in the world of cryptocurrency. The ripple effect of BlackRock's Bitcoin purchase is already visible in the emergence of new Bitcoin ETFs. Now, for those not familiar with the term, Bitcoin ETFs, or exchange-traded funds, are a type of security that tracks the price of Bitcoin. They are designed to allow investors to participate in the Bitcoin market without actually having to buy, store, or secure the cryptocurrency themselves. Following BlackRock's move, we've seen a surge in the creation of these Bitcoin ETFs in the US, with 9 new spot Bitcoin ETFs appearing on the scene. These funds are attracting significant capital, showing that investors are keen on getting a slice of the Bitcoin pie without the hassle of handling the cryptocurrency themselves. However, the creation of these ETFs doesn't come without challenges. One of the main hurdles is Bitcoin's fixed supply. You see, Bitcoin is capped at 21 million units. This fixed supply may pose difficulties for creating new ETF shares in the future. When new ETF shares are created, authorized participants place orders and submit cash, with the corresponding Bitcoin purchases being made the next trading day. This process can potentially affect Bitcoin prices, especially considering that ETF shares can trade at a premium or discount to the net asset value. It's also important to note that while buying and selling Bitcoin on exchanges directly affects its prices, ETF shares do not have a real-time impact on Bitcoin prices. Instead, Bitcoin futures are used to keep prices in line. As these Bitcoin ETFs evolve, the long-term impact on Bitcoin prices will gradually unfold. This is a story that's still being written, and it's one we'll be following closely. After all, the rise of Bitcoin ETFs has the potential to significantly shape the future of Bitcoin and the wider cryptocurrency market. As these Bitcoin ETFs evolve, the long-term impact on Bitcoin prices will gradually unfold. The supply of Bitcoin is under strain, and this could potentially push the price to unprecedented heights. Let's dive into the numbers. Bitcoin's supply is capped, with a limit of 21 million units. Already more than 19 million have been mined, and we're seeing a decrease in new issuance due to a halving event. This event reduces the daily production of Bitcoin from 900 to 450 units. In contrast, the demand for Bitcoin is growing, especially from exchange-traded funds, or ETFs. Since the SEC's approval of spot-based Bitcoin ETFs, firms like BlackRock and Fidelity have made record-breaking debuts, amassing over $35 billion in assets under management. These ETFs are demanding more Bitcoin than miners can produce, with an average daily demand of 2,577 units, far exceeding the daily mining output. This increasing demand and decreasing supply are causing a crunch in the Bitcoin market. The supply available for trading on exchanges is dwindling, and history has shown us that this usually leads to bullish trends. Some market experts even suggest that we could see a Bitcoin price surge to over $100,000 by the end of 2024. But it's not just about supply and demand. Investors are also looking at Bitcoin as a hedge against currency debasement and for portfolio diversification. They're not just front-running the supply crunch, they're investing in the future of Bitcoin. As we approach the next bull market, predicted to begin in late 2025, Bitcoin prices could potentially reach six figures. This is an exciting time for Bitcoin and those invested in it. With the decreasing supply and increasing demand, Bitcoin could be on the verge of a major price surge. As we look towards the future, the recent developments in the Bitcoin market suggest a promising outlook. The advent of spot-based Bitcoin ETFs and the increasing attention from institutional investors like BlackRock have not only validated Bitcoin's position in the financial world, but also set the stage for a potential bull market. Starting late 2025, market analysts project a bullish trend for Bitcoin, envisioning a world where Bitcoin prices could soar into six-figure territory. This might seem like a bold prediction, but let's not forget. Bitcoin's supply is capped at 21 million units, and with the halving events reducing new issuance, the constraints on supply are only going to tighten over time. Furthermore, the rising demand for Bitcoin from institutional investors and the popularity of Bitcoin ETFs have been exceeding the daily mining output. This supply-demand dynamic, coupled with historical bullish trends post-halving, suggests a potential price surge, potentially pushing Bitcoin over the $100,000 mark by the end of 2024. Apart from the potential for high returns, Bitcoin is also being seen as a hedge against currency debasement. As fiat currencies continue to be affected by inflation and economic instability, Bitcoin's decentralized nature and capped supply make it a reliable store of value. It's like digital gold, except it's more portable and easier to divide. Moreover, Bitcoin is increasingly being viewed as a tool for portfolio diversification. With its low correlation to traditional asset classes, Bitcoin can offer a degree of risk mitigation, serving as a buffer against market volatility. As we watch this space, one thing is clear. Bitcoin is not just surviving, it's thriving. BlackRock's Bitcoin purchase has undeniably set a precedent in the financial world. This move not only affected the market but also led to the creation of new Bitcoin ETFs. The introduction of these ETFs, in turn, has constrained Bitcoin's supply, potentially paving the way for a price surge. Moreover, this series of events, coupled with Bitcoin's promising future outlook, signals a significant shift in the financial landscape. As we continue to monitor these developments, one thing is clear. The world of cryptocurrency is on the cusp of a new era, and BlackRock's move could very well be the catalyst for this change. Have you ever wondered what the buzz around Bitcoin halving in 2024 is all about? In the vast and ever-evolving world of cryptocurrencies, Bitcoin has established itself as a frontrunner. One of the most intriguing aspects of Bitcoin's design is a cyclic event known as halving. This event, occurring approximately every 4 years, cuts the reward for mining new blocks in half. The Bitcoin network is gearing up for its next halving event in 2024. This event has the crypto community on its toes given its historical impact on Bitcoin's value. It is believed to be a catalyst for volatility, bear markets, and even bull runs. But what does it all mean? Why does halving happen, and what does it signify for Bitcoin and its investors? Let's delve deeper into what Bitcoin halving actually means. Bitcoin halving, in essence, is a mechanism designed to control the supply of Bitcoin. But what does this mean? Imagine a gold mine, where miners work tirelessly to extract gold. Now, every 4 years, the amount of gold they can extract halves. This means mining becomes progressively more challenging and less profitable. The same principle applies to Bitcoin mining. The Bitcoin protocol, a complex piece of cryptographic engineering, has this halving mechanism built right into it. Satoshi Nakamoto, the mysterious creator of Bitcoin, designed it this way to mimic the scarcity and deflationary nature of precious metals like gold. Every 10 minutes, new blocks are added to the Bitcoin blockchain. These blocks contain a record of all recent Bitcoin transactions. The miners, who use powerful computers to solve complex mathematical problems, add these blocks. For their efforts, they are rewarded with some Bitcoin. This process is known as block rewards. Here's where the halving comes in. When Bitcoin was first launched in 2009, the block reward was 50 Bitcoins. However, every 210,000 blocks, or approximately every 4 years, this reward halves. By 2020, the block reward had been halved to 6.25 Bitcoins. This halving mechanism serves a dual purpose. First, it controls the supply of new Bitcoins entering the market, preventing an oversupply situation. Second, it creates an incentive for miners to continue mining, as the decreasing supply of Bitcoin can lead to an increase in its value. So, to wrap up, Bitcoin halving is a built-in feature of the Bitcoin protocol that reduces the reward for mining new blocks by 50%, roughly every 4 years. This mechanism ensures that Bitcoin remains scarce, making it a deflationary currency. Now that we understand what Bitcoin halving is, let's explore the historical impact it has had on Bitcoin's price. History has shown that Bitcoin halving events often lead to a significant increase in Bitcoin's price. To understand this, let's take a step back in time. The second Bitcoin halving occurred in July 2016. Leading up to this event, Bitcoin was trading at around $650. Fast forward to the end of 2017, and Bitcoin had soared to an astonishing $20,000. That's a more than 3,000% increase in value. Now let's jump to May 2020, the time of the third Bitcoin halving. Bitcoin was trading at approximately $8,500. By December 2020, Bitcoin had skyrocketed to nearly $30,000, and it didn't stop there. In April 2021, Bitcoin reached an all-time high of approximately $64,000. That's a 7-fold increase in less than a year. So, what's the magic behind these price jumps? It boils down to simple economics: supply and demand. When the supply of Bitcoin reduces due to halving, and demand remains constant or increases, the price naturally goes up. In other words, the reduced rate of new Bitcoin entering the market makes existing Bitcoin more valuable. But it's not all roses and rainbows. It's important to note that these price surges often come after a period of increased volatility and price corrections, as seen in 2017 and 2021. This is partly due to speculation and market sentiment around the halving events. With this in mind, what can we anticipate for the 2024 Bitcoin halving? Speculations are rife about what the 2024 Bitcoin halving might mean for the crypto market. With the date drawing nearer, analysts, enthusiasts, and skeptics alike are all throwing their hats into the prediction ring, attempting to forecast the potential impact of this significant event. Firstly, let's talk about the bullish predictions. Some experts like Jirayut Srupsrasopa, CEO of BitCub Capital Group Holdings, predict a prosperous period for Bitcoin and the broader cryptocurrency market in 2024 and 2025. This optimism is rooted in the historical pattern of Bitcoin experiencing a bull run during its halving period. The halving, which happens every 4 years, reduces mining rewards by half and has traditionally contributed to a rise in Bitcoin prices. But, as with any financial market, the path to these potential gains is unlikely to be smooth. Before the expected bullish phase, the market may experience volatility and corrections. After all, the crypto market is renowned for its roller coaster-like price swings, and the period leading up to the halving is unlikely to be an exception. However, not everyone shares this bullish outlook. Some, like Huobi co-founder Du Jun, suggest that Bitcoin is entering a bear market, with the next major rally not expected until late 2024 or early 2025. This viewpoint suggests that we may see a prolonged downturn similar to the Bitcoin winter experienced between late 2017 and mid-2019. And then there's the concept of a golden period for Bitcoin prices post-halving. This theory suggests that the reduced supply of Bitcoin, resulting from the halving, could lead to an increase in demand and subsequently an increase in price. If this theory holds true, we could see a period of significant growth for Bitcoin in the years following the 2024 halving. While these predictions offer a glimpse into the possible future, it's essential to remember the inherent unpredictability of the crypto market. The only certainty is uncertainty, making it crucial for investors to stay informed, vigilant, and adaptable. So, what have we learned about Bitcoin halving? Let's do a quick recap. Bitcoin halving is a process deeply embedded in the code of Bitcoin, occurring approximately every 4 years or after every 210,000 blocks have been mined. This event reduces the reward for mining Bitcoin by half, effectively slowing down the rate at which new Bitcoins are created. This scarcity mechanism was designed as a deflationary measure to ensure the longevity of Bitcoin, as the total number of Bitcoins that will ever exist is capped at 21 million. Looking back in history, we've seen that Bitcoin halving events have typically been followed by significant increases in Bitcoin's price. The halvings in 2016 and 2020, for instance, both led to tremendous bull runs in the following year. However, it's important to bear in mind that while the past may provide some clues, it doesn't necessarily dictate the future. The world of cryptocurrency is influenced by a myriad of factors, and it's always wise to consider the bigger picture. As for the upcoming halving in 2024, expectations are running high. Some experts predict a golden period for Bitcoin prices, while others warn of potential volatility. It's a mixed bag of predictions, but one thing is certain: the halving will once again put Bitcoin in the spotlight and could potentially be a catalyst for major market movements. But here's the key takeaway: Bitcoin halving isn't just a technical event, it's a reminder of the innovative and disruptive power of blockchain technology. It's a testament to Bitcoin's built-in economic model, one that challenges traditional financial systems, and it's a catalyst for change, spurring innovation and driving the evolution of the cryptocurrency market. As we inch closer to the 2024 Bitcoin halving, remember to stay informed, stay cautious, and most importantly, stay excited about the fascinating world of cryptocurrency. Ever wondered how to start investing without the hassle of picking individual stocks? Enter ETFs. Exchange-traded funds, or ETFs as they're more commonly known, are essentially investment funds that are traded on stock exchanges, much like individual stocks. But here's the twist. Instead of buying shares in a single company, when you buy an ETF, you're buying a basket of stocks, bonds, or other assets. It's like getting a sampler platter at a restaurant. A little bit of everything, all in one go. So, why is this a good thing? Well, imagine trying to keep up with the performance of hundreds, or even thousands, of individual stocks. It would be akin to trying to keep track of every single car on a busy freeway. With ETFs, you don't have to. They provide broad market exposure, meaning you're spreading your investment across a wide range of assets. It's like having eyes on the entire freeway, not just one car. But wait, there's more. ETFs also offer instant diversification. By investing in a diverse array of assets, you spread your risk. If one company or sector doesn't perform well, your investment doesn't take as big of a hit because you're not just invested in that one area. It's like not putting all your eggs in one basket, or in this case, not betting all your money on one car. And the benefits don't stop there. ETFs typically have lower fees than mutual funds. This means more of your money goes towards your investment rather than lining the pockets of fund managers. Plus, ETFs offer better liquidity. They can be bought and sold throughout the trading day at market prices. Mutual funds, on the other hand, are only priced at the end of the trading day. So in essence, ETFs offer a simpler, more efficient way of investing in the financial markets. Now let's dive into the world of ETFs in 2024. Exchange-traded funds, or ETFs as we like to call them, have seen a remarkable growth in the past few years. The number of available ETFs for US investors has grown by a staggering 46% in the past 3 years, a testament to their soaring popularity. But what's driving this surge? Well, a few things. ETFs offer easy entry into investing, providing broad market exposure and easier management compared to individual assets. They offer instant diversification, low fees, and better liquidity compared to mutual funds, making them an attractive choice for both seasoned and novice investors. Now, choosing an ETF isn't as simple as picking the one with the biggest growth. There are a few key factors to consider. First, industry diversification. An ETF that spreads its holdings across a wide range of industries can help mitigate the risk of any one sector performing poorly. Next, trading volume. ETFs with higher trading volumes tend to have tighter bid-ask spreads, which can reduce the cost of buying and selling shares. They also tend to be more liquid, which makes it easier to buy and sell shares without impacting the price. Lastly, the expense ratio. This is the annual fee that all funds or ETFs charge their shareholders. It's crucial to pay attention to this as it directly reduces your returns. The top ETFs for 2024 have low expense ratios, which means more of your money stays in your pocket. In addition to these, it's also essential to keep an eye on the ETF's returns. Positive returns are, of course, a good sign. But remember, past performance is not a guarantee of future results. It's just one piece of the puzzle when choosing an ETF. So, why are we talking about all this? Because ETFs have transformed the investing landscape. They've made it easier for everyday people to dip their toes into the world of investing, offering a simple, cost-effective way to diversify their portfolios. Therefore, ETFs have become an increasingly popular choice for investors in 2024. Now that we understand the growth and importance of ETFs, it's time to explore some of the best-performing ETFs of 2024. First on the list is the SPLG ETF, which tracks the S&P 500. This ETF offers investors an easy way to gain exposure to 500 of the largest US companies. With its low expense ratio, it's a cost-effective way to get broad market coverage. Next up, we have the RSP ETF. Unlike SPLG, RSP gives equal weight to every stock in the S&P 500, not just the largest ones. This strategy can lead to higher returns when smaller companies outperform their larger counterparts. Turning our attention to income-focused investors, the SCHD ETF is an excellent choice. This ETF focuses on high dividend-yielding stocks, making it a fantastic option for those seeking regular income investments. For those looking at a heavy portfolio, the QD ETF has exposure to the NASDAQ 100. This ETF includes the biggest and most innovative tech sector, such as Apple, Microsoft, and Amazon. Last but certainly not least, the ACWX ETF provides international market diversification. This ETF tracks non-US companies, allowing investors to gain exposure to markets around the globe. It's an excellent choice for those looking to diversify beyond US borders. Each of these ETFs has its unique features, making them a great fit for different investment strategies. Whether you're looking for broad market exposure, income generation, tech sector concentration, or international diversification, there's an ETF out there for you. So these top-performing ETFs have been leading the pack in 2024, offering investors a variety of options to diversify their portfolios. You might be thinking, how do ETFs influence the financial markets? Well, let's dive right in. First off, ETFs significantly contribute to market liquidity. By pooling a diverse collection of stocks, bonds, or other assets into one tradable entity, they create a more liquid market for these underlying securities. This means that investors can buy and sell these assets more readily, which in turn can help to keep the market moving smoothly. Next, ETFs play a crucial role in price discovery, the process of determining the price of an asset in the marketplace through the interactions of buyers and sellers. By reflecting the value of a broad range of securities in real time, ETFs provide a transparent and accurate snapshot of market sentiment. This makes it easier for investors to assess the value of individual assets, contributing to more efficient pricing. But what about market volatility? Interestingly, ETFs can both dampen and amplify market swings. On one hand, their ability to provide diversification can help to spread risk and reduce the impact of any one security's price movement. On the other hand, because ETFs can be traded throughout the day like stocks, they can also contribute to increased trading activity, potentially leading to greater short-term volatility. Finally, ETFs democratize access to different asset classes and sectors, from commodities to international stocks. This wide accessibility contributes to market efficiency by allowing a larger pool of investors to participate in the market, which can help to ensure that more accurately reflect the true value of assets. In conclusion, ETFs play a crucial role in shaping financial markets, influencing price discovery, and offering investors a way to gain exposure to a wide range of assets. So we've navigated the world of ETFs, but what does this mean for you as an investor? Well, gaining a solid understanding of exchange-traded funds can give you the upper hand in the investment game. It allows you to make more informed decisions about your portfolio and potentially better returns. Think of ETFs as your gateway to the world of investing. They offer broad market exposure, instant diversification, and lower fees compared to mutual funds. This means you can gain exposure to hundreds or even thousands of positions in a single fund, saving you time and effort in research and monitoring. But remember, not all ETFs are created equal. Some track the S&P 500, others focus on dividend stocks or offer international market diversification. It's essential to do your homework and understand the ETF before you invest. Look at aspects like expense ratios, industry diversification, and trading volumes. Remember, knowledge is power, and understanding ETFs is a crucial step in your investment journey. Stay informed, stay invested. Now let's talk about Bitcoin halving. This intriguing event, a built-in feature of Bitcoin's design, is one that effectively splits the reward for mining Bitcoin transactions in half. Imagine it as a kind of digital stock split, but with a twist. Instead of doubling the number of shares, Bitcoin halving cuts the reward for miners by 50%. This event doesn't happen randomly or by surprise. It's a scheduled occurrence, taking place approximately every 4 years, or more precisely every 210,000 blocks. This predictability is part of what makes Bitcoin and its underlying blockchain technology so fascinating and revolutionary. Why does this happen, you might ask? Well, Bitcoin halving is a method of controlling the supply of this digital currency. It's a counter-inflation measure, designed to keep Bitcoin's growth steady and sustainable. By halving the reward for mining, the rate of new Bitcoin entering the market slows down, preventing an overflow of the digital currency. This ingenious mechanism is a testament to the forward-thinking design of Bitcoin's mysterious creator, Satoshi Nakamoto. It's a nod to the scarcity principle, a concept well known in the world of economics, which suggests that limited supply can increase value. As we dive into the world of Bitcoin halving, we will also touch on its implications. It's not just a matter of having rewards. This event has ripple effects throughout the entire Bitcoin ecosystem, influencing miners, investors, and the overall market dynamics. So, with the understanding of what Bitcoin halving is, what does that mean for 2024? In 2024, Bitcoin is expected to undergo a bull run during its halving period. This is a prediction made by Jirayut Srupsrisopa, the CEO of Bitcub Capital Group Holdings, and if you're wondering why, let's delve a little deeper into the world of Bitcoin. Bitcoin halving, for those who might not know, is a process that occurs every 4 years where the rewards for mining Bitcoin are halved. This effectively reduces the supply of Bitcoin, making it a rarer commodity. And as we know from basic economics, when the supply of something decreases and the demand remains the same, the price tends to rise. This is the principle that underpins Srupsrisopa's prediction for a golden period in 2024. Historically, we've seen Bitcoin's price surge in the aftermath of each halving event. The last two halvings, in 2016 and 2020, led to significant bull runs. And with the next halving event slated for 2024, it's reasonable to expect another surge in Bitcoin's price. But here's the twist. While the halving event could potentially trigger a price surge, it could also lead to increased market volatility. This is because the reduced mining rewards might discourage some miners, causing a drop in the network's hash rate, and potentially leading to price instability. So while we might be looking forward to a golden period, we should also brace ourselves for potential market corrections leading up to the halving. Moreover, it's worth noting that Bitcoin doesn't exist in a vacuum. Its price is also influenced by a myriad of external factors. Geopolitical issues, changes in regulatory policies, technological advancements, and even the state of the global economy can all impact Bitcoin's price. While the predictions sound promising, remember that the market is also influenced by other external factors. So while we can look at historical trends and make educated guesses about the future, it's crucial to remember that the world of cryptocurrencies, like any other investment sector, is subject to the unpredictable ebbs and flows of the market. Halving events are not the only factors influencing Bitcoin's value. There's a whole universe of variables that can sway the trajectory of this currency. For instance, geopolitical have a significant impact. Think about it. Bitcoin exists in a digital realm, yes, but it's still influenced by real-world events. Trade wars, political instability, regulatory changes. All these can cause ripples in the crypto market, sometimes turning ripples into waves. Then there's the ongoing global health crisis. The impact of COVID-19 on the economy has been undeniable, and Bitcoin is no exception. The pandemic has led to increased market volatility across the board, affecting traditional and digital markets alike. It's been a roller coaster ride, with Bitcoin experiencing some extreme highs and lows. Now let's draw upon the wisdom of some industry insiders. Du Jun, co-founder of the Huobi crypto exchange, has voiced his predictions. He suggests that Bitcoin is potentially entering a bear market, a period of falling prices that could lead to a prolonged downturn. But don't be too quick to despair. Du also predicts the next major rally to kick off around late 2024 or early 2025. Keep in mind though, that these are just predictions. Bitcoin's price movements have proven time and again to be notoriously hard to forecast accurately. Even the most seasoned experts can be caught off guard by sudden market shifts. So, as we look ahead to the halving event of 2024 and beyond, it's essential to remember these other influencing factors. The crypto market, like any other, is subject to the ebb and flow of global events, economic trends, and investor sentiment. With these factors in mind, it's clear that the crypto market remains unpredictable. But that's not necessarily a bad thing. After all, with unpredictability comes the opportunity for significant gains. Just remember to approach with caution and always do your research. Even with the unpredictability, Bitcoin remains a prominent player in the digital currency world. The future of Bitcoin, like any other financial asset, is difficult to predict with absolute certainty. However, certain aspects of its design, such as the halving mechanism, give us clues about its long-term trajectory. Bitcoin halving, a pre-programmed event that cuts the reward for mining Bitcoin in half, is a significant factor influencing its future. The process will continue until the Bitcoin has been mined. Given the current schedule, it isn't expected until the year 20. This means that we're still in the early stage cycle, with only 90% currently in circulation. The remaining will be slowly released to the market over the next 100+ years. Process that could potentially rise Bitcoin's price long term. This of the remaining Bitcoin also the deflationary nature of cryptocurrency that has led some to view Bitcoin as a hedge against it. Despite its advantages, Bitcoin is not risks. The market is notoriously volatile, with prices swinging wildly in periods of time. The overall for Bitcoin has been one, especially during periods following each event. The next expected in 2020 could potentially be another golden for Bitcoin, since the bull runs we've seen in the past. However, it's important to keep in mind that external factors, such as geopolitical events or monetary policies, can also significantly impact Bitcoin's price. As we approach the next Bitcoin halving in 2024, it's important to keep these points in mind. Remember, the world of cryptocurrency is complex and always changing, so always do your research and stay informed. There's a seismic shift happening, moving us from the traditional Bitcoin halving discussion to a broader perspective: the stock market. You might wonder how these two vastly different financial realms connect. Well, recent events surrounding Bitcoin have significantly impacted the stock market. Now, to understand this, let's first demystify Bitcoin. In simple terms, Bitcoin is a digital currency, a form of wealth that exists only online and is not controlled by any central authority like a government or a bank. It's a bit like digital gold, mined by computers solving complex mathematical problems. Now you might ask, how does this digital gold affect the stock market? Well, think of the stock market as an ocean, and Bitcoin as a sizable rock. When the rock is steady, the ocean is calm. But when the rock is dropped into the ocean, it creates ripples. And these ripples disturb the tranquility of the water. In the same way, the rise and fall in Bitcoin prices create ripples in the global economy. When Bitcoin prices soar, investors are drawn to this digital gold rush, often pulling resources from traditional investments, including stocks, and pouring them into Bitcoin. This shift of capital can cause the stock market to wobble. On the flip side, when Bitcoin prices plunge, it can trigger a sell-off as investors scramble to cut losses. This panic can spill over into the stock market, leading to a drop in stock prices. Moreover, companies directly involved in Bitcoin trading or mining are listed on the stock exchange, so any fluctuation in Bitcoin prices directly impacts their stock value. So, in essence, the performance of Bitcoin has become a barometer for the stock market, and its fluctuations can create waves felt far and wide. Now that we've established the connection between Bitcoin and the stock market, let's delve deeper into understanding this correlation. You see, Bitcoin, as a digital asset, is often seen as an alternative to traditional investments like stocks. But it doesn't exist in a vacuum. Its price movements can, and often do, influence the stock market in a variety of ways. Think of it like this. Imagine the financial market as a gigantic, interconnected web, where each thread represents a different asset. When one thread jiggles, it sends vibrations throughout the entire web. That's the effect Bitcoin can have on the stock market. Now let's break it down further. When Bitcoin prices surge, it can trigger a ripple effect. This surge often generates a lot of news and hype, which can spark interest among investors. This enthusiasm can lead to increased investment activity, which can bring about increased market volatility. On the flip side, when Bitcoin prices drop, it can cause a wave of uncertainty. This can lead some investors to pull back, causing a decrease in market activity and a potential slowdown in the stock market. But remember, this isn't a one-size-fits-all scenario. The correlation between Bitcoin and the stock market can vary based on a range of factors, including investor sentiment, economic conditions, and regulatory news. Let's use a basic example to simplify it. Say you're an investor who holds both Bitcoin and stocks. If Bitcoin prices go up, you might feel wealthier and more confident, leading you to invest more in stocks. Conversely, if Bitcoin prices drop, you might feel less financially secure and decide to sell off some of your stocks. Hence, Bitcoin isn't an isolated entity in the financial world. Its movements can cause ripples in the stock market, affecting investor sentiment and market trends. Bitcoin's influence extends beyond the general market trends. It can have a direct impact on individual stocks, especially those linked to digital currencies. Now let's dive into how a shift in Bitcoin prices can influence these specific stocks. Consider companies that have invested heavily in Bitcoin. For instance, Tesla, the electric vehicle giant led by Elon Musk, made headlines in early 2021 when it purchased $1.5 billion worth of Bitcoin. Now imagine the impact on Tesla's stock if Bitcoin's value were to plummet or soar. Tesla's stock price is, in part, influenced by the performance of Bitcoin, given its significant investment in the cryptocurrency. Now let's shift our attention to companies whose business models are intertwined with digital currencies. A prime example is Coinbase, the largest cryptocurrency exchange in the United States. Coinbase's revenues are directly tied to the trading volumes of cryptocurrencies, including Bitcoin, so a surge in Bitcoin's price can trigger more trading activity, possibly leading to higher revenues for Coinbase, and potentially a boost in its stock price. However, it's important to understand that this relationship between Bitcoin and individual stocks isn't always straightforward. Other factors such as company performance, market sentiment, and broader economic indicators also play key roles in determining a stock's price. Yet the impact of Bitcoin's price movements on these stocks cannot be ignored. Take the case of MicroStrategy, a business intelligence company that holds a significant amount of Bitcoin on its balance sheet. A drop in Bitcoin's price can lead to a devaluation of its assets, which could negatively impact its stock price. On the flip side, a surge in Bitcoin's price could increase the value of its assets, potentially providing a boost to its stock price. So, Bitcoin's performance can be a determining factor in the fate of individual stocks, especially those with a strong tie to the digital currency world. We've traversed the landscape of Bitcoin's influence on the stock market. It's time to pause, recap, and ponder over the future implications. In our journey, we've seen the ripple effect of Bitcoin on the stock market. As Bitcoin's value fluctuates, it sends ripples through the financial world, affecting the value of stocks and causing the market to react in tandem. This is a dance that we've seen play out time and time again. Next, we delved into understanding the correlation between Bitcoin and the stock market. We found that while Bitcoin is a relatively new player in the financial world, its influence is undeniable. Bitcoin's value can sway investor sentiment and cause shifts in the stock market, thus creating a tangible connection between these two entities. We then explored Bitcoin's impact on individual stocks. From Tesla's investment in Bitcoin to the broader tech sector, we've seen that Bitcoin's price changes can have a direct impact on the value of individual stocks. This relationship further underscores the interconnectedness of Bitcoin and the stock market. Now, as we gaze into the future, we see that these trends are likely to continue. The influence of Bitcoin on the stock market is not a fleeting phenomenon, but rather a new reality that investors must navigate. As Bitcoin continues to evolve, its impact on the stock market will likely become even more pronounced. This is why it's crucial for investors to keep a close eye on Bitcoin trends. Whether you're an individual investor or a large corporation, the world of Bitcoin can have direct implications for your investment decisions. By staying informed and understanding the interplay between Bitcoin and the stock market, you can better position yourself for financial success. In conclusion, the world of Bitcoin and the stock market are more intertwined than one might think. As we move forward, this correlation might become even more significant, shaping the investment decisions of tomorrow. Ever wondered how a dog's face on a digital token could possibly influence the price of Bitcoin, the world's leading cryptocurrency? To understand this, we first need to dive into the world of meme coins. Meme coins are a distinct breed of cryptocurrencies, born out of internet culture and humor. Their inception can be traced back to the creation of Dogecoin, a playful spin-off from Bitcoin, adorned with the face of the Shiba Inu dog from the popular Doge internet meme. Unlike Bitcoin, which was designed with a serious intent to revolutionize finance, Dogecoin was created more as a joke, a satirical critique of the wild speculation in cryptocurrencies. However, what started as a joke soon took on a life of its own. The birth of Dogecoin marked the beginning of a new wave of digital currencies, known as meme coins. These coins, often inspired by internet memes or pop culture references, have seen a rapid rise in popularity, largely driven by social media platforms and their vast user base. Platforms like Twitter and Reddit have been instrumental in pushing meme coins to the mainstream. A single tweet or post can send prices skyrocketing, as seen with the infamous Dogecoin tweets by Elon Musk. This viral nature of meme coins, coupled with the FOMO, fear of missing out effect, has led to a surge in their demand. However, it's important to note that meme coins are highly volatile and speculative in nature. Their values are largely driven by hype and social media trends rather than underlying fundamentals. This makes them a risky investment, prone to sudden price swings and even crashes. Now that we understand the meme coin phenomenon, let's delve into its relationship with Bitcoin. Bitcoin and meme coins, two players in the crypto arena, but how exactly do they interact? You see, as different as they may appear, these two entities share a symbiotic relationship, each influencing the other in subtle yet significant ways. Let's start with the popularity of meme coins. These fun, often lighthearted cryptocurrencies have exploded onto the scene, capturing the attention of investors around the world. But how does this affect Bitcoin? Well, it's all about the sentiment. The hype and excitement surrounding meme coins can stir up positive feelings towards the entire crypto market. This heightened market sentiment can, in turn, influence Bitcoin's price, pushing it upwards. But the relationship goes deeper. Meme coins often serve as an entry point for new investors. They're accessible, affordable, and let's face it, they're a lot of fun. This influx of new investors broadens the crypto market. As these newcomers gain experience and confidence, many start exploring other cryptocurrencies. Bitcoin, with its reputation and proven track record, often becomes the next logical step. So in a way, meme coins act as a gateway, introducing fresh faces to the world of Bitcoin. This increased demand can drive up Bitcoin's price. But it's important to remember that the relationship between Bitcoin and meme coins isn't a one-way street. Bitcoin's performance also influences the meme coin market. When Bitcoin soars, it can instill a sense of optimism across the crypto landscape. Meme coins, riding this wave of positivity, can also see price increases. In essence, the meme coin wave can create ripples that reach the shores of Bitcoin. But how has this played out recently? In 2024, Bitcoin's price has seen a significant increase. But what role have meme coins played in this? Bitcoin's price has been on a roller coaster ride, with notable firms like Fundstrat and Standard Chartered predicting a surge to heights of around $180,000 and $120,000 respectively by the end of 2024. These predictions were based on various factors, including increased mining profitability, the potential launch of a Bitcoin ETF, and the upcoming halving event in April 2024. Interestingly, around the same time, we've seen an unexpected rise in the popularity of meme coins. These fun, community-driven cryptocurrencies have been making waves in the crypto space, with many people investing in them for their potential high rewards, despite their inherent risks. Now let's talk about the potential correlation between Bitcoin's price increase and the meme coin frenzy. While it's challenging to establish a direct correlation, it's plausible that the hype surrounding meme coins could have indirectly influenced Bitcoin's price. The increased attention towards the crypto space driven by the meme coin craze might have led to a surge in new investors, thereby contributing to the demand for Bitcoin. On the flip side, some believe that the rise in Bitcoin's price could have fueled the meme coin boom. As Bitcoin's price increased, more people became interested in the crypto market. This growing interest possibly led to the exploration of other coins, including meme coins, resulting in their increased popularity and subsequent price spikes. Moreover, noteworthy events have also had an impact. For instance, the announcement of potential Bitcoin ETFs and the anticipation of the Bitcoin halving event in 2024 have stirred up excitement in the market, possibly influencing both Bitcoin and meme coin prices. While it's impossible to pinpoint one single factor as the cause of Bitcoin's price increase, the meme coin craze certainly seems to have played a part. The crypto landscape is ever-changing, and the impact of meme coins on Bitcoin's price is a testament to this dynamism. As we delve deeper into the implications of these trends, it's crucial to understand their potential impact on future Bitcoin prices. The recent surge in Bitcoin's price, partly driven by the meme coin phenomenon, has set the stage for intriguing possibilities. Forecasts from financial giants like Fundstrat and Standard Chartered predict a bullish future for Bitcoin, with price targets soaring up to a staggering $180,000 before the next halving in April 2024. What does this mean for investors? For those holding Bitcoin, the outlook is promising. The launch of a Bitcoin ETF could potentially attract new investors and significantly boost demand. With the halving event on the horizon, we could see a further increase in Bitcoin's value as daily mining rewards decrease, driving up the price to meet the equilibrium between buyers and sellers. For those speculating on meme coins, the landscape is a bit more complex. The meteoric rise of these digital assets has turned them into significant market players. While they were once considered risky, their influence on Bitcoin's price surge has solidified their position in the crypto market. But, as with any investment, there are risks. The volatile nature of these coins means prices can plummet just as quickly as they rise. However, the potential rewards are enticing. As meme coins continue to gain traction, they could offer lucrative opportunities for savvy investors. Yet it's essential to remember that in this dynamic environment, trends can shift rapidly. The key to navigating this space is staying informed, understanding the risks, and being prepared to adapt to market changes. As we continue to navigate the unpredictable waters of cryptocurrency, one thing is clear: meme coins, once considered a passing fad, are now a force to be reckoned with. So, could a meme coin really influence the price of Bitcoin? The answer, it seems, is a resounding yes. Throughout this video, we've explored the fascinating relationship between Bitcoin and meme coins, and how the recent surge in Bitcoin's price has been affected by these digital jesters. We've seen how the rise of meme coins has ignited market sentiment, bringing in a wave of new investors who are eager to get a piece of the pie. This influx of fresh capital is driving up demand, which in turn exerts upward pressure on Bitcoin's price, and this is not an isolated event. As we've discussed, the interplay between Bitcoin and meme coins is a recurring theme that has been playing out in the crypto markets. As we move forward, it's clear that understanding the interplay between Bitcoin and meme coins will be crucial for anyone involved in the world of cryptocurrency. Until next time, keep your eyes on the charts and your mind open to possibilities. Check out our other videos for a deep dive into profitable strategies and investment tips. Be sure to like, comment, and subscribe.